Central banks and the gold wave. Why central banks turn to gold. Over the past several years, central banks around the world have made a clear and deliberate move toward gold. Since 2022, annual purchases have exceeded 1,000 tons for 3 consecutive years, a level that had never been sustained before in modern monetary history. These figures are confirmed by institutions such as the World Gold Council and Reuters, which gives this trend strong credibility. Importantly, this shift is not driven by short-term speculation or attempts to profit from rising prices. Central banks do not trade like investors. Instead, they are reassessing which assets can preserve value, credibility, and stability in a world increasingly shaped by geopolitical tensions, sanctions risk, and financial fragmentation. In this environment, gold has re-emerged as a strategic reserve asset rather than a tactical one. A historic surge in demand. The scale and consistency of central bank demand are especially important. The year 2022 marked an all-time modern record for official gold purchases. That record was effectively repeated in 2023 and again in 2024, when total demand was later revised upward to 1,086 tons. Expectations remain strong into 2026. This persistence across multiple years tells us that gold buying is not a reaction to a single crisis. Instead, it reflects a deeper structural change in how reserves are managed over the long term. Gold as an anchor. Asset central banks act as long-term holders, not short-term traders. Their sustained purchases help stabilize global gold demand, reduce reliance on volatile financial assets, and reinforce confidence in reserve systems. In uncertain times, gold now anchors trust. Who is buying the gold? Key buyers in the global East. In recent years, gold buying has increasingly been led by countries outside the traditional Western core. China, India, and Poland have emerged as regular and consistent buyers, while other emerging markets such as Turkey and Singapore participate more selectively. This shift reflects broader changes in global economic power and a growing desire to reduce reliance on reserve systems dominated by Western currencies. Instead of depending heavily on the US dollar or euro-based assets, many of these countries are turning toward gold as a neutral and politically independent reserve. As a result, global gold demand is becoming increasingly multipolar, mirroring the wider fragmentation of the global financial system. Poland's standout role. Poland provides a particularly clear example of how deliberately a central bank can reshape its reserve profile. In 2024 alone, Poland added approximately 90 tons of gold, making it the single largest buyer globally that year. This was not opportunistic or reactive buying. It followed a long-term strategic goal to raise gold's share of reserves toward or even above 20%. Beyond the financial logic, this move also carried strong political and symbolic meaning, signaling sovereignty, resilience, and preparedness in a region sensitive to geopolitical risk. Expectations. Looking forward, surveys of reserve managers show that 95% expect further net gold purchases in the near future. At the same time, many anticipate a lower future share of US dollar assets. Together, these expectations suggest that the trend toward gold is expected to persist, not fade. The post-2022 turning point. Frozen reserves as a wake-up call. After 2022, central banks around the world witnessed an event that fundamentally changed how reserve safety is understood. Roughly $300 billion of Russian sovereign reserves were frozen following geopolitical conflict. These assets were held within foreign financial systems and clearing infrastructures that had long been considered reliable. Suddenly, reserves that were assumed to be secure became inaccessible overnight. Similar precedents, such as the freezing or redirection of Afghanistan's reserves, reinforced the message that political and legal risks can override formal ownership. For reserve managers, this moment acted as a clear and unavoidable warning, redefining safety and reserves. As a result of these events, the definition of what makes an asset safe began to change. Liquidity and yield alone were no longer sufficient. Sovereign control, physical ownership, and legal certainty became top priorities. Trust in foreign clearing systems weakened, and many central banks reassessed how exposed their reserves were to external decisions. This shift reshaped long-standing reserve strategies. Gold, as political insurance gold, stands apart because it is independent of foreign governments, resistant to sanctions, and universally accepted. With no issuer and no counterparty risk, gold functions as political insurance, protecting sovereignty when access to financial infrastructure is restricted. Diversification away from the dollar. Declining confidence in USD dominance. Although the US dollar remains the world's dominant reserve currency, confidence in its long-term exclusivity has clearly weakened. In recent years, trade tensions, sanctions policies, and broader geopolitical conflicts have highlighted the risks of relying too heavily on a single currency system. The increasing use of financial sanctions and the so-called weaponization of finance have raised concerns among reserve managers about concentration risk. As a result, many central banks have begun to question whether traditional dollar-heavy reserve portfolios still provide sufficient protection in a more politically fragmented global environment. Diversification is no longer viewed as optional, it has become a strategic necessity. Why gold fits the role. Gold fits naturally into this diversification process because it is neutral and globally recognized. Unlike reserve currencies, gold is not issued by any government and does not depend on the policies of a single country or institution. It has historically performed well during periods of systemic stress and financial disruption. Rather than replacing other reserve assets, gold complements them by providing balance and resilience when currency-based assets face pressure. A structural portfolio shift. This move toward gold represents a long-term rebalancing of reserve portfolios, not a short-term response to price movements. Coordinated across many central banks and reinforced by official surveys, reserve strategies are being fundamentally rewritten for a more uncertain world. Inflation, rates, and bond volatility. The bond market shock. Between 2022 and 2024, global financial markets experienced one of the sharpest interest rate tightening cycles in decades. As inflation accelerated, central banks responded with aggressive rate hikes, which had a direct and severe impact on bond markets. Real yields fluctuated heavily, and bond portfolios, long considered the safest component of reserves, suffered meaningful losses. Assets that were traditionally viewed as stable and predictable failed to provide protection at the exact moment they were most needed. For reserve managers, this period challenged long-standing assumptions about the reliability of bonds as a defensive asset. Gold's role during volatility. During this period of instability, gold played a very different role. While it does not generate interest income, it acted as a neutral hedge within reserve portfolios. Gold proved less sensitive to rapid changes in interest rates and helped reduce overall portfolio risk when bonds and other assets moved in the same direction. Empirical data from this period supports the conclusion that gold regained relevance precisely because it behaved differently when traditional correlations broke down. In turbulent markets, diversification once again proved its value. Lessons for reserve managers. The key lesson from this episode is that risk management now outweighs return optimization. Diversification must include real assets, correlations can shift unexpectedly, and liquidity and resilience matter most. Gold does not offer growth, but it offers balance when stability is under pressure.